Hello everyone, I'm Danyal Talebpour. I and my friends are going to teach you accounting and its functions for beginners. Just like I said in our first video, the main source will be accounting principle written by Horngren. And unfortunately, because of this corona epidemic, we have to prepare these lectures while at home. I wish we could have done this in classrooms using projectors and all. So I hope you come along with us. Let's have a quick summary on the first chapter. The main purpose was to bring you all to the accounting world by discussing rules, concepts, and some important vocabulary. And now in this chapter, which is chapter 2, we're gonna use all that knowledge. In other words, we're gonna put it to action. We use accounting in real life a lot, and because of that, it never meets the eye. For instance, budgeting our monthly money or calculating interest for loans, even recording our memories in diaries by the order of their time of their happening. It's imbued with our lifestyles, and this fact is, we can say that this fact is undeniable. Anyway, suppose that some guy is trying to start up a business, a small company, a marketing company, and as you all know, he hires maybe 3 or 4 people, and because our company is weak, we don't need any specific people to do the accounting for us. That's why the owner himself can do the accounting. All he needs is a pen and a notebook. But as the business grows and expands, it requires specialists, just like accountants. That's when the whole thing starts. Okay, and to start the chapter, in this slide, the following diagram summarizes the accounting process in this chapter. The first stage is to record transactions. The second one is to copy or post to the accounts. And the last one is to prepare the trial balance. We're going to go through these stages one by one, so don't worry. But before we go further, I'm going to teach you some important and useful terms that you need. The first one is account. It says that it's a detailed record of the changes in a particular asset, liability, or owner's equity. And you can see that it's the basic summary device of accounting. We use this term a lot in our lives. For instance, when we try to open up a bank account, which is a cash account, and put some money to it, whether we withdraw money from it or put more money in it, it always increases or decreases. And in order to record that, we need accounts, which means accounts shows the changes in those particular assets or liabilities or owner's equity. The next one is ledger. But before I talk about this ledger, I'm going to teach you about journal. It says that it's a chronological record of transactions, which means, in other words, every transaction that is related to our business that concerns our company must be recorded in the journal first. And there's this important word, chronological, in here, which means that we have to record our transactions by the time they happen in order of their happenings. And it might be really hard in the past because they used notebooks, and it was hard to keep track of all our accounts and their transactions. But nowadays, because of some softwares and applications, just like Pitch3, it's much more easier to do this whole thing. And the last term in this chapter, which will be useful, and my friend will talk about it more, is a trial balance, the list of all our accounts with their balances. In this slide, you see the accounting equation includes revenues and expenses. As you already know, because it was in the first chapter, in the accounting equation, assets must always equal liabilities and owner's equity, which means any changes in our assets, maybe it was for increase or decrease, on the other side, we must do the same too. For example, if our assets increase, we must either increase our liabilities or our owner's equity. And now, there are three main categories for our accounts, according to our accounting equation. The first one is asset. Assets are economic resources that will benefit the business in the future. Just like our cash accounts that I talked about it a bit earlier, or maybe a car, a building, they are all our assets, they are belongings that will benefit us in the future. The next one is liabilities, which are simply, you can put their debts. For example, when we lend our friend some money, it's a liability to our friends. These are called liabilities. The next one is owner's equity. The owner's claim to the assets of the business is called owner's equity. We'll go through all this in detail, so don't worry about that. This is a list of our asset accounts that are in this chapter. The first one is cash, which always shows the cash effects of our transactions. I talked about it a bit earlier. It might increase or decrease. The cash account shows these changes. It's a record that shows these cash effects. The next one is notes receivable and accounts receivable. Before I talk about these two, I'm gonna determine and examine the first part, receivable. Receivable means the customer, a person, will pay us an amount of money in the future. That's called a receivable. But for the first part, which is notes and accounts, for notes receivable, it's a written pledge, a written promise that our customer will pay us a fixed amount of money by a certain date in the future. But for accounts receivable, it's just an oral or implied promise of future payments in the future. So you can say that it's less reliable because it's just implied promise. It's oral. The next one is prepaid expenses. There are some expenses that we always pay in advance. We often pay them in advance, beforehand. For example, rental expenses or insurance. These are called prepaid expenses. The next three are land, building, equipment, furniture, and fixtures. These three, their accounts shows the cost of them. For land, it's a record that shows the cost of our land. For building, it shows the building's business, the business building. It could be office, a warehouse, a store, doesn't really matter. But we need to understand the fact that these accounts, it shows their cost. And for the last one, which is equipment, furniture, and fixture, it's the same. It shows the cost of these assets. The next category is liability accounts. There are three in this chapter: notes payable, accounts payable, and accrued liabilities. For notes and accounts payable, they are the exact opposite of notes and accounts receivable, with very important difference. For payables, we say that we have to pay an amount of money to some person, to some company. It's a debt, which is liability, of course. And for notes and accounts part, for notes payable, we say that it's the opposite of notes receivable, which means it's a written pledge that we pay a certain amount of money within a certain date. It's a written pledge, a written promise. The next one is accounts payable, which is an oral or implied promise, just like accounts receivable, because they are the exact opposite. The last one is accrued liabilities, that there are expenses that has not been paid, just like taxes payable or interest payable. We haven't paid this yet, so we call them accrued liabilities. next one is owner's equity accounts. It's the last category. There are 4 in this chapter, and the first one is capital. We say that in this sentence, the capital account shows the owner's claim to the assets of the business. Just like I said earlier, when someone tries to open up a business, start up a business, a company, that person usually brings some belongings to the business. For example, investments, cash, or maybe land, building. These are called, our owner has claims to those assets. They are called capital. And then for the next one, which is withdrawals, it says that the amount taken out of the business. For example, when our owner withdraws some money for personal usage, it's called a withdrawal. The next one is revenue, which is always the increase in our owner's equity that is usually created by delivering goods or performing services. It depends on the type of our company. And the last one is expense. It says here that expenses use up assets or create liabilities in the course of operating a business. For assets, we said that they are economic resources that will benefit us in the future. But for expenses, we say that they are economic resources that has already benefited us in the past. In other words, when we slowly consume assets, they become expenses. In this slide, I'm going to teach you the double entry system. And it means that we always record the dual effects of a business transactions. But for that, let's just say that first we have to identify the type of our account. We had 3 types. After we did that, we're going to use the T account, as you see in here. The T account, we call it the T account because it takes the form of the capital letter of T, as you see in here. You see, on the top of the T account, we indicate the type of our account, which is in here, it's cash. And for this part, left-hand side, for left side, we call it debit. And for the right side, we call it credit. For debit and credit, there are many explanations and theories. But for now, let's just agree to memorize it, because if I tell it about it and to explain it to you, you're going to mess up. It's a bit hard to understand it. So please don't hold that against me. In the first, I talked about journal and ledger. I said that the ledger it holds all our accounts. It's the final form. And to do that, we use the T account. And as you see here, the T account for our ledger, when we put that transaction, when they happen, we're going to put them to the ledger. And our ledger, it holds all our accounts in the form of the T account. And now, in order to increase and decrease in the accounts, we said that we have to identify the type. After we did that, we use this following summary. For assets, we say that increases are recorded on the left or debit side, but decreases are recorded on the right side. But for liabilities and owner's equity, decreases are recorded on the left side and increases are recorded on the right side. They are the exact opposite. The reason of this is because of the accounting equation. As you see here, the debit and credits must always equals. As the accounting equation you see in here, assets must always equal liabilities and owner's equity. And for this exhibit, for asset, we said that for increases, they are debit, but for decreases, they are called credit. But for liabilities and owner's equity, it's the exact opposite, which means debits are for decreases, while increases are credits. And this was my part for this lecture. I hope you all liked it. Thanks for your attention. And now my dear friend Sama will continue the rest. Thank you.
Okay, thanks dear Daniel for your explanation. Hi guys, I'm Sama. I'm Zandi. Hope you're doing well. Let's start the next part of the chapter. Recording transactions in the journal. Accountants record transactions first in journal, and the journalizing has 3 steps, which are specify each account affected and classify each account by type. Determine whether each account is increased or decreased. Record the transactions in the journal, including a brief explanation. The debit side should enter first and the credit side last. Total debits should always equal total credits. Here we are going to explain an example about Gagelen, a travel agency, and we want to analyze their transactions. The first transaction shows that the recipients of Gielen's $30,000 cash investments in the business. When we want to post them to the journal, each entry should have a date. The date when the transaction occurs. Here, April 1st, the transaction occurs. So we should put April 1st. Then the accounts which are involved. Here, the accounts are cash and Gagelen capital. And here you can see on part D and part E, the dollar amount which are debited and credited, which is $30,000. And the explanation is received investments from owners. As you see, the most important part of any journey is post reference. Each account has a post reference, which is abbreviated to REF. For example, for cash, we use 101. The first one shows that cash is an asset. This reference helps accounting softwares to manage assets, liabilities, and owner equities better. The first one shows that cash is an asset. The next number, which is 0, shows that cash is a current asset. If it is non-current or long-term, we should put 1. And the next one shows that cash is the first item of our assets. We use post-reference for assets, liabilities, and owner equity for all of them. Cash is the first item of assets, so we should put 1. For Gagelen capital, the reference is 301. 3 shows that Gagelen capital is an owner's equity. And O shows that it is current, and 1 shows that it's the first item of it. Pay attention to this part. After this journey, we should put them to the ledger accounts. You know, ledger is the next and final item when we are going to post the journal to them. So for being easy to understand, we use T accounts. For each entry, we should create the T accounts. The accounts which are involved here is cash and Gagelen capital, so we should create them and debit cash $30,000 and credit capital $30,000. As you see, panel A describes transaction, and panel B shows the journal. The page number appears on the upper right corner of the accounts. Then the dates when the transaction occurs. Here it is April 1st, 2000x5. And then the accounts which is debit and the accounts which is credit and the explanation at the and the amount which are debited and credited. After that, we should put them to the ledger accounts. It is important to put them by their reference. For example, for cash, the reference is 101, so we should put it on the page 101 on the ledger accounts. As you see, at the upper right corner of the ledger, you can see the post reference of each account. You can see 101 for cash and 301 for capital. And here you can see the flow of accounting data from the journal to the ledger. First, the transaction occurs. Then, source documents are prepared. And after that, transaction analysis takes place. And then, transactions is journalized and posted to the ledger account. As we said, for the first transaction, we say the accounts are cash and capital. As you see, it is accounting equation, which is assets equal liabilities plus owner's equity. Cash is an asset and given capital is owner equity. I talked about this earlier, so we should go to the next transaction. This transaction says that Gillen paid $20,000 cash for land. We want to buy something. When we want to buy something, our cash is decreased. Cash and land, both of them are assets. So when we want to buy something, our assets is increased. So and then we want to pay for it, so it is decreased. So cash, it is be decreased, and it should be credit, and land should be debit and increased for $20,000. As you see, the references here, which is for land, we use 113. 1 means land is an asset. The next 1 shows that land is long-term asset, and 3 shows that land is the third item of the assets. So after that, we should put into the T accounts. We had cash accounts before, so we just put this $20,000 on it. And for land, we should create the account. The next transaction says that Gillen purchased $500 of office supplies on account. The accounts which are involved are office supplies and account payable. Both of them increased $500. So we should debit office supplies $500 and we should credit account payable $500. And the explanation is purchase supplies on account. And immediately we should put them to the ledger or T accounts or that $500. Transaction 4 says that Gillen paid $300 on the accounts payable created in transaction 3. At transaction 3, we had $500. On this transaction, we had $300. So we should credit cash and we should debit account payable. Account payable decreased, so it should be debit, and cash decreased, so it should be credit. And immediately post them to the T accounts. Transaction 5 says that Gay Gillen remodeled her home with personal funds. You know, it is not a transaction for the company. It is something that the owner do it. For example, buy something, sell something. It is not related to the company. It is just for her or for his uses. so we make no entry for it. The next one says that Gillen withdrew $2,000 cash for personal living expenses. We want to withdraw, so our cash decreased, so we should credit it. And Gillen withdrawals decreased $2,000, so we should debit it. And as you see, the post references are 311 and 101. And you can see the T accounts also. Here you can see all the T accounts which are involved in that agency. For assets, we had cash, office supplies, and land. And for liabilities, we have accounts payable. And for owner's equity, we have Gagelen capital and Gagelen withdrawals. Each account has a balance. So total debit should always equal total credit, as I said. So you can see the balances here. The normal balance of an account. An account normal balance appears on the side of the account's debit or credit. For example, assets normal balance is debit, so we call them debit balance accounts. And for liabilities and owner's equity, the normal balance of them is credit, so we call them credit balance accounts. Here it's the trial balance, which my dear friend Kian is going to explain for you. Thanks for paying attention to me, and
Thank you very much, Sana. Hello, everyone. My name is Kian Mahmoudpour. I will be with you in this part of chapter 2, and I'm going to talk about trial balance, correcting trial balance, and finally I will solve one comprehensive question for you. So let's start. Here on this page we have the trial balance. But what is trial balance? A trial balance is an internal document that lists all accounts with their balances that taken from the ledger. And first we will write assets in there. After that, liabilities, and finally owner's equity. And the order of owner's equity is first capital, then withdrawal, after that service revenue, and finally the expenses. In a manual accounting system, the trial balance provides a check on accuracy by showing whether total debits equal total credits or not. So it's a useful tool in accounting. And in all types of systems, the trial balance is a useful summary of the accounts and their balances. And this internal document can maybe taken at any time, but the most common time is at the end of the accounting period. On the next page, you can see an example of trial balance. The first step to provide and prepare this internal document is we have to write some data on the top heading of this document. At first line, we will write the name of the business, such as BMW, Ford, Gagelen, Amazon, and etc. At second line, we will write the title of the document. Here we want to provide and prepare the trial balance, so we will write the trial balance. At the third line, we will write the specific date for this document that we want to prepare. And usually it's at the end of the month or year. Be careful. Here we will write at, for example, at March 31 or at December 31. We don't write, for example, for month ended March 31 or December 31. It is very important point. And as you can see here, we have reference column, we have accounts title, and accounts title, be careful, it's first assets, then liabilities, and finally owner's equity. And the order of owner's equity, as I said before, a few moments ago, it's first capital, then withdrawal, after that service revenue, and finally the expenses. And finally, the total debits should equal completely to total credit. On the right side on this page, you can see the name of some of the financial statements. I mean income statements, the statement of owner's equity, and balance sheet. Maybe you ask me why the order of accounts and these things that you told me, it is important in trial balance. I have to say that if we go from the bottom to the top of the trial balance, it will be very great. Look here, if we subtract all expenses from all revenue, that here only we have service revenue, our result will be net income or net loss. For example, net income. After that, we will transfer and post this net income to the statement of owner's equity. And our result in the statement of owner's equity will be the capital ending balance. After that, we will transfer it to the balance sheet, and our work will be very easier. So one of the very important goal and purpose to provide and prepare the trial balance is make our work easier. On the next page, there are two important points. The first one is we shouldn't confuse the trial balance with balance sheet. A trial balance is an internal document that only company insiders like our managers use it. But balance sheet, and it doesn't necessarily completely to follow the standards. But balance sheet is one of the most important financial statements. And company outsiders like banks, for example, get only the company's financial statements. So here I want to tell you a point and links to the chapter 1. In chapter 1, we talked about management accounting and financial accounting. About trial balance is an internal document and it doesn't necessarily to follow the standard. So it refers to management accounting. But about balance sheet is one of the most important financial statements, and it is necessary and essential to follow the standards. So it refers to financial accounting. It is very important. The second one is in trial balance, the order of expenses is from highest to lowest. So not only the order of the owner's equity and accounts is important, but also the order of expenses is important, and it is from highest to lowest. Imagine we have rent expense $50 and salary expense $100. In trial balance, first we will write the salary expense because it is from highest expense to lowest expense. On the next page and another page, you can see Sama's example, I mean Gagelen e-travels example. Here you can see 1, 2, 3, 4, 5, 6 T accounts and their balances. All assets account, all withdrawal and all expenses have the normal balance of debit, and all liabilities, all revenues like service revenue, and all capital have the normal balance of credit or right side. Okay, here as you remember 1, 2, 3, 4, 5, 60 account from Sama's example, and on the next page you can see Gagelen e-travels trial balance. At first line the name of the company, at second line the name of the document, and at the third line the specific date at April 30, 20x5, not for month ended, at. It is very important, at April 30, 20x5. As you can see here, it is journal and ledger reference. Here accounts title, first assets, then liabilities, and after that owner's equity, that are capital and withdrawal. And here we have the balances. And total debits is completely equal to total credits, and it's $30,200. And here, if you notice, we have 60 accounts. 1, 2, 3, 4, 5, 6 accounts. And on the last page, we had 6 accounts, T accounts too. On the next page, we have correcting trial balance errors. In a trial balance, total debits completely should be equal to total credits. But if they are not, there is an error. Computer accounting systems eliminates most errors. You know why? Because most software like Pete software won't let you make a journal entry that doesn't balance. But unfortunately, computer cannot eliminate all errors because humans can input the wrong data in there. Errors can be detected by computing the difference between total debits and total credits on the trial balance. Then we can perform one or more of the following actions. But before I'm going to talk about these two items, I have to say our mistakes can be very wide in variety. So we can't solve all unequal trial balance with these two items. We can't solve the most of them, but these two items is the most important ones. So the first one is we can search the trial balance for a missing account. For example, maybe our accountants forgot one or more accounts from the ledger and transfer it to the trial balance. So we have to get back and post it and transfer it all or one of them to the trial balance. The second one is divide the difference between total debits and total credits by 2. You know why? Because a debit treated as a credit or vice versa, a credit treated as a debit, and doubles the amount of errors. This item is helpful when we input the accounts in a wrong place. For example, cash is a subset of assets, and it has the normal balance of debit, but we will input it in the credit. So we can divide the difference between total debits and total credits by 2 and follow this item and action. The next page, we have the comprehensive and complete example that I told you at the first of my talking. Here we have the Larry Tomasini Computer Service Center, and we have 10 transactions during the March. And the requirement of the question are, the first one is open the T account for accounts beginning balance, for some of accounts, of course, because the information of the question is for some of the accounts. And the second one is journalize each transaction. And third one is post it to the ledger. And finally, prepare the trial balance and the financial statements. So let's start. Here on this page, we open the T account with their balances at the 1st of the March. Of course, some of accounts, not all of them. If you notice here, only cash and accounts receivable, accounts payable, and capital have the the first period beginning balance. Cash and accounts receivable has the normal balance of debit, so we will write it on the left side. And accounts payable and capital have the normal balance of credit, so we will write them on the right side. On the next page, we have the transaction. The transaction A. Larry Tomasini borrowed $45,000 from the bank and signed the note payable in the name of the business. Here, in this transaction, our involved accounts are cash and notes payable, and both of them are increased. So we will write cash on the debit side and notes payable on the credit side. And the digit of these accounts are $45,000. The next transaction is Larry Tomasini paid cash of $40,000 to a real estate company to acquire a land. The business acquired a land, so our involved accounts are land and cash. Both of them are the subset of the assets. One of them, land, increased, so we will write it on the debit side, and another one decreased, and we will write it on the credit side. And the digit of these accounts, both of them are $40,000. The next one is perform service for a customer and received cash of $5,000. Here, our involved accounts are cash and service revenue, and both of them increase. One of them subset of assets and another one subset of owner's equity. The digit of both of them are $5,000. The next one, purchase supplies on credit, $300. Be careful, on credit, not pay cash. Our involved accounts are supplies and accounts payable. If it was cash, we will write cash except accounts payable. But here it's on credit, so supplies on debit side and accounts payable on the credit side. Both of them the digit $300. The next one is performed customer service and earned revenue on account $2,600. Our involved accounts here are accounts receivable and service revenue, because still we don't receive any money, only we perform the service. And our involved accounts here are accounts receivable $2,600 on the debit side and service revenue $2,600 on the credit side. The next one is paid $1,200 on account. It is very easy. Accounts payable credit side and cash on the accounts payable $1,200 on the debit side and cash $1,200 on the credit side, and both of them decrease. Another transaction is paid the following cash expenses: salaries expense 3,000, rent expense 1,500, and interest expense $400. Here, this transaction is very interesting because we can do two things, or we have two ways. One of them is you separate entry, for example, salary expense on the debit side 3,000 and cash 3,000 on the credit side. But we can use combined entry in this transaction. For example, salary expense, rent expense, and interest expense, all of them on the debit side, and only one account, cash, on the credit side. It is combined entry, and the digit of cash will be $4,900. The next one is received 3,100 on account. Our involved accounts are cash and accounts receivable. One of them increased and another one decreased. So the accounting equation is completely equal, and the digit of this transaction for both accounts are $3,100. Another one is received the 200 utility bill that will be paid next week. Our involved accounts are utilities expense on the debit side 200 and accounts payable 200 on the credit side. But be careful, here still we didn't pay anything, and we will pay cash on the next week. Still we won't pay anything. So our involved accounts is one of them utilities expense is easy, but another one accounts payable, not cash. Be careful. The last transaction is withdrew 1,800 for personal use. It is very easy withdrawal. Increase 1,800 on the debit side and cash decrease 1,800 on the credit side. Be careful. The effect of capital and service revenue on owner's equity is positive. It means when they increase, the owner's equity will increase too. But the effect of withdrawal and expenses is negative on owner's equity. It means that when they increase, the owner's equity will decrease, or vice versa. When they decrease, the owner's equity will increase. So it is important at this point. And here you can see all journalizing on 2 pages, and in your exam you should draw this form. It doesn't necessary to draw it on the separate page, it is for teaching. And on this page, finally, we will transfer and post all transactions in the T account, and all assets, all withdrawal and expenses have the normal balance of debit, and all liabilities, service revenue and capital have the normal balance of credit or right side. And here you can see that, and each account has the balance, the separate balance, and the digit is completely, you can see it. And here on this page we have the Larry Tomasini Computer Service Center trial balance at March 31, 20x2. On the left side is journal and ledger reference. After that, accounts title. At first it's assets, after that liabilities, then owner's equity. And the order of owner's equity is first capital, then withdrawal, then service revenue, and finally expenses. And the order of expenses is from highest to lowest. If you notice here, it's first salary expense, because it's the most, it's the biggest digit. It's $3,000. After that, rent expense 1,500. After that, interest expense 400, and finally utilities expense that it is $200. And finally, the total debits is completely equal to total credits, and the digit is $82,400. After that, okay, we have income statement. Larry Tomasini Computer Service Center income statement for month ended March 31, 20x2. It is like a video, it's not like a snapshot. It is different from trial balance and balance sheet. In trial balance and balance sheet, we say at, for example, March 31, but here it's like a video. It's for a period. It's for month ended March 31, 20x2. And we subtract all expenses from our revenue, and our result will be the net income. And it is completely predictable because the number of service revenue is bigger than all number of expenses, so our result will be net income. And another name of the income statement is the statement of operations, and then we will transfer this net income to the statement of owner's equity on the next page. Yes, Larry Tomasini Computer Service Center, the statement of owner's equity for month ended March 31, 20x2. First, we have capital beginning balance, for the 1st of March. It is 28,500, and we will add to net income that it is 2,500, and we will subtract the withdrawal with these two digits. And our result will be the capital ending balance. Here we don't have the investment by the owner, but if we had it, we will write it under the statement of owner's equity, and it will be summed to these numbers. After that, this capital ending balance will transfer it to the balance sheet on the next page here. Larry Tomasini Computer Service Center balance sheet at March 31, 20x2. On the left side, we have all assets. On the right side, we have all liabilities and owner's equity. And in proprietorships, company only, we have capital ending balance, capital for March 31, that it is 29,200, that is taken from the statement of owner's equity. And finally, total assets, it is equal to total liabilities and owner's equity. And the number of these is $75,500. And another name of the balance sheet is the statement of the financial positioning, because it shows the position, the business and the company. Yes, and finished. Our presentation is over. Thank you for your attention. I hope you enjoyed our teaching and enjoyed this chapter. Thank you very much.
Okay, thanks guys for your attention. I hope I will see you on the next video. Thanks.
Thank you.
Special thanks to Kian and Sama for their efforts and energy. I hope you all liked it and found it useful. For our next video, we're going to teach you adjustments in accounting. If you wanted to communicate with us, you can use these email addresses, and have a nice day. See you next time. Goodbye.